So, how do you follow up an episode featuring both the CEO and the COO? I'll tell you how. You go out and you find real specialists in the field. And today, I don't have one, I've got two for you. One is a specialist and knows all the facts about the Sydney Swans, and the other one is a specialist in the TV show Maths. But it also happens that they know a little bit also about our topic that we're discussing, complex risks. I'll let you try and figure out which is which. Welcome to Strata in Conversation. Roll the clip. We are back, and this is our monthly episode or conversation series that is meant to be engaging and informative to help you do your jobs in whatever part of the Strata insurance industry that you're in. So welcome and thanks so much for joining us. As a reminder, for all of you who are logged on live to the stream, and I can see how many we have, you are entitled to receive continual professional development points that will be emailed to you directly following this series. What I can ask is please just allow some time for our team to get those issued and directed out to you. They will be coming. Also, I can let you know for those who aren't able to log on live, we do have now that you'll see with QR code on the screen, a live YouTube channel that you're able to go on and view any of this or any of the past episodes of Strata in Conversation. So please go and check out by clicking on the QR code at the scanning the QR code or clicking on the link that is now being populated momentarily into the live chat. Speaking of the live chat, as always, we do have specialists that are manning that chat. So if there are any questions, queries, challenges to what our specialists are saying, please let them know and we'll get those answered for you in the chat. But now, let me welcome our specialists in. Not only are they specialists in what I mentioned this morning, but we will be discussing complex risks. And I couldn't think of anyone better than these two gentlemen to help me out in uncovering what it all means. Steve, Frank, how you guys going?
Very good. Yourself?
I'm pretty good. Steve.
Good to be here, Steve.
Steve Tchepak. Can you tell me about the latest episode of Maths, please?
God, no. And if I could, I would hang my head in shame and leave this webinar immediately.
So I've just exposed our resident maths expert. Frank, how are you going today? How are you feeling about the current series?
Oh, very good. I understand we've only got 45 minutes, so I don't want to take up the whole time talking about maths, but I'm available offline anytime for discussions on this.
100%. So I actually am very, very excited to have you both here. If you caught our last episode, Frank and Steve, we had Kim and James discussing all things what the state of play is. But we thought that this was a really important topic as well, complex risks and what they are and what the current landscape is and what it means for all the people logged on the call. But what I'd really love to do is start in the obvious place. So Frank, when we are talking about complex risks and we hear that term come up a lot, what are we discussing when the term complex risks comes up at the most basic level?
Yeah, thank you, Steve. So at the most basic level, a complex risk is simply a property that is harder to insure in the current insurance market cycle. So the reasons why the building could be harder to insure could be how it's used, could be its location, it could be the tenants that are associated with it, or the condition of the building. That might be because of its age or because how it was developed. So when we look at these harder to place or complex buildings, we categorize them into three different categories. The first one is high hazard tenancies, and that could include the 2Ts, tobacconists, or tattoo parlors. It can be high hazard manufacturing or wholesaling. It can be adult services or student accommodation and boarding houses. That's one. The second category can be complex risk due to defects or due to combustible cladding. So the defects may be systemic in nature, they may be material, the combustible cladding might be on a large part of the building. And the third reason is location. You think alpine, above the snow line, or FNQ.
So I think you kind of answered, that's a really amazing description there, and I'll come to Steve to add anything in a moment. But how is that decision? Because I think there's certain things that come up when we talk about complex risks and the type of businesses or properties that you've just mentioned in those three categories. Steve, how is it determined that, yes, this is a complex risk? Is there like a matrix or a checklist? How do we get there, Steve?
Yeah, sure. So, of course, underwriters and insurance companies have guidelines and so on in place, but let's strip it right back to what the average person knows. So, there's a lot of mystique and magic about what insurance companies do and what underwriters do with information, but strip it right back to what an average person would feel about risk. And sometimes it's good to look outside our industry and just look at car insurance, for instance. Now, if you asked the people in the audience who the most dangerous or the highest exposure is in car insurance, I think majority of people, if not all, would say young males under the age of 25. Why? Because the data shows they're more prone to accidents and risk-taking behavior. So that sort of standard logic applies to why insurers choose to write certain types of risks. It's all about the exposure which attaches to a specific type of risk. So you don't necessarily have to be an underwriting expert to know what is more dangerous than something else. For instance, is an office more dangerous than someone selling volatile chemicals or firearms or explosives? All of these things are pretty straightforward. And yes, there's a lot of underwriting smarts which goes in behind it. But I think you don't need to be an insurance expert or underwriter to break down what really is a higher exposure than other things.
And do people sometimes, and now I'm talking people in the industry, do people sometimes disagree on what is a complex risk and what isn't? Is that at all subjective, or is that like a hard black and white line?
No, it is. It's up to each insurer's appetite, really. So there can be a conflict between what is perceived as complex or not. But again, to use another analogy, insurers are investing capital to get a return, and they're choosing the basis of which they do that. So if I use another example, if I get three human investors who are dabbling on the share market, one might be really conservative and look for lower returns. One might have a mixed portfolio of high risk to low risk. Another might be a major risk taker and just be investing in volatile stocks and things like that. Insurers are really no different. Yes, there's more smarts which goes behind it, but they are choosing to invest their capital across a variation of risks, and it's up to them to decide what risks they're taking on. Some might have a conservative approach, others might be willing to have a mixed portfolio, others are willing to write those hard to place risks or complex risks with the expectation of potentially achieving more capital, but with that comes the higher risk of potentially larger claims as well.
Understood. I think the last question that I had from sort of this baseline understanding, and I love the way that you've drawn that picture for us so well, is of all of those elements that Frank laid out in his initial description, Steve, from your instance and where you sit in CHU, is there the most common trigger or the main effect that pushes a risk from standard into that complex arena? Is there one common thing that you see?
Well, Frank did a good job of categorizing the common things, but if I had to pick one out of those, it's definitely occupancy. Because when it comes to, at the end of the day, buildings are exactly what they are, whether they're commercial or residential, they are still bricks and mortar. It's what's happening inside them can increase your potential for large losses in particular. So fire losses we might be looking at, or catastrophic losses involving ram raids or other malicious claims. So I'd definitely say occupancy, but as Frank alluded to in his introduction, there are other factors at play as well.
So let's go back to Frank. I love how Steve sort of painted the picture and like gave that the drawing to car insurance. Can you give us, in your experience, and a real life example that our listeners could really sort of relate to, as to a real life example of a complex risk or an instance that you've been involved with?
Absolutely. So it's actually one that I was discussing with the broker last week on, and the reason why it really stands out is because when Flex Complex had just gone live, and what happened was the broker approached us, said, "I've got this risk, and it definitely would sit from what we see into your Flex Complex bucket." And when we looked at it, had over 250 defects, had an EPS on the building, and there was an NCAT in order. And when you looked at those 250 plus defects, they were across hydraulic, general, waterproofing, structural, and ranging from mild to severe. But that was quite a lot. And what had happened was that building had been sitting on the hard to place market for a few years. So what happens over that time? The policy keeps getting renewed, but there was no action. So what you see is you've got the defects just sitting there, potentially getting worse, no clear direction how to address them. Lot owners really stuck within that position. You've got reports that are aging, of being of less value. People have spent their time and money to go and get these reports for the property, and they're not being utilised in any way, shape, or form. We had cover that was being degraded every year. So OBL got excluded, legal defence got excluded, liability was excluded. So what that meant was that the broker and the committee had to go out and then source those auxiliary covers as well. With the EPS that was on the building, the committee was very unclear how that EPS was affecting their policy. And then you had the owners corp who was really tied up in the NCAT proceedings, so really drawing their attention into that. So what we did, we looked at it, we went through all the reports. It was very exciting to work with the launch of Flex Complex on this one. And what we saw that when we looked at the reports that were there, a couple of things really stood out. Number one was that the property was classified 1A. So what that meant was that the EPS that was on the building, which was legal and compliant, was much less of a risk than the committee and the broker had been led to believe. The second thing was that there'd been an updated smoke alarm system installed, which met Australian standards in the last 2 years. So what you saw right off the bat was that we could reduce materially the Section 1 and the fire excess from 6 figures and slash them right down to more appropriate levels. What we then did, it was quite exciting. The first time we had done it with Flex Complex is that we integrated the building resilience services into the underwriting of this. And what the building resilience services team did, they did a digital scan of the building, so through the LiDAR and drone, and they did a digital twin. And then they got all these reports that had happened through all different consultants all over a number of years. And they put it into this one report. And what they did, basically, they ranked everything from high to low. It was really cool, little traffic lights, and said, these are your big issues. These are the things to address. These are the things which are impacting your premium. These are the elements that you can work on to actually move your building from a complex risk to a standard risk. So really exciting, really cool to see that come to life. So what we're able to do after all of that, we provided that to the broker with the terms. They met with the committee. They're really excited about what that could mean. And what that meant was they were able to offer 12-month terms. OBL, legal expense and liability was included again in the cover. We're able to provide that clarity in terms of the defects and the key issues. But most importantly, and pretty excitingly, what we provided was a path forward. So they weren't just sitting there spinning wheels, getting the cover renewed every year, everything excluded, cover degraded, very unclear how to move forward. You've got these lot owners who are sitting there, people who own these properties, who are seeing the value of their lots decrease because they are unclear how to address it. We then provide a path forward, we provide better cover, and that was a really exciting and fun thing to do and to launch it. So it's something that the broker and I still discuss, but very pleasing and quite a innovative and fun way to launch Flex Complex, and a good way to show the capability.
What a case study! That sounds like an amazing outcome. What I'd love to do is I'd love to go back to sort of what you just said about 20 seconds ago. You were talking about the impact to lot owners, and without this Flex Complex solution, I just want to understand the complex risk itself without the solution, whether that's Steve or Frank. When a complex risk is identified, what does that look like for those lot owners that are in there? What's the impact to them when they find out, hey, I'm a tenant or I'm an owner or I'm whatever inside something that is now that I thought was a standard risk is a complex risk? What is that impact, Steve?
Yeah, so very good question. I mean, there's the owners I have feel most sympathy for are the ones who buy into new developments in good faith. It's their lifelong dream. It's their first home. They're all excited, and we have one in our CAG group where we insure this very big tower, and it came to be that there were defects, serious defects, to the tune of millions of dollars. So you can imagine the impact, the impact of the highs and lows of that, the excitement of buying your first property, to the lower thinking, oh my God, I've got so much material defects, which is going to cost so much. How are we going to afford to pay for this? What's going to happen to the value of our home? And the real life case example of that was a building which we insured as part of a broader group, where it had to be co-insured. And what that meant was two insurers had to take a percentage of a building just because the sums insured were so large. In this case, we were able to offer 50% of the cover for around $100,000. To put into example the impact on lot owners, the remaining 50% was placed overseas for a bill of $1.2 million. That is not a misspeak. $1.2 million. So imagine the impact on lot owners. And one of those examples like that was one of the reasons, the catalyst for launching Flex Complex, to be honest, because yes, with higher exposure comes higher premiums and so on, but we wanted to try to bring a brand into the market where, yes, some complexity needs to be allowed for in premium excesses, but to try to make it more palatable and affordable to the average everyday person, because stories like that are pretty heartbreaking at the end of the
I
day.
can't. Yeah, that's such a base picture that you paint around, like, so I've got the dream, I've saved up the deposit, I've got the mortgage, and then all of a sudden I find out that the building isn't exactly, or I've bought into a building that may have an occupancy issue or a hazard issue or a defects issue, and all of a sudden those fees that I hadn't accounted for are a real part of my life. And it sounds like we're coming, and I'll let Frank talk about more about in detail about the solution. But it sounds like that's something that is a real apparent thing in our industry. Would that be correct, Frank?
It is. And to Steve's point, like this could happen to anybody, right? Anybody, whether it's a new development, whether you're in an established building and you find out there's systemic water failure and water ingress, it can happen to anybody. And we always have to go back to, you've got people who are living in that property who've made the biggest purchase of their life, who are trying to live their lives of all their other stresses, and now have this pressure on them where they have increasing premiums. If they can get cover at all, you might have remedial works happening. Like that, just think about that situation and what they're in. So Steve gave a really good example. We hear lots of examples of small 10 lotters, very manageable premium. Tobacconist moves in downstairs, their premiums increase by 10 times. So, they're really hard things to hear. And they are really applicable to everybody and anybody. And again, to Steve's point, one of the things that when Flex spoke to the market about potentially doing complex risks was the belief that we could underwrite them in a sound way and provide fair and reasonable premiums.
So, Steve, I now have a question for you. The bat phone rings, you pick it up, and you hear that we have a complex risk. How does an insurer, what steps do they take, or how do they handle it when they are faced with a new complex risk?
Well, if you're an insurance nerd and part of my team, you probably get all giddy with excitement because it's one of the more challenging things to underwrite. And it's one of the more interesting things to get our mitts on. But when it comes to a complex risk, there's standard characteristics to a risk which apply regardless of whether you're complex or not. And everyone's familiar with that, like claims history and what it's built from and where it is and all of those things. But it depends on the complexity of why the risk is actually complex. So if it's because of occupancy based, what information do we need to make sure that we're managing the exposure? So for instance, if it's a tobacconist, what sort of security measures do they have? What sort of licensing regimes do they have? Are they susceptible to ram raids or other impact claims by having bollard protection and things like that? What level of CCTV is there? all of these things. So it's a deeper dive into existing information you have. So you normally ask these questions at a base level, but you're diving much deeper into them. If I take another example and think of a high hazard industrial, so dealing in dangerous goods, whether they're flammable, whether they're chemicals, whether they're any of those things, we want to make sure they're being stored in accordance with appropriate statute. We want to make sure that their fire protection is second to none. So a normal quote slip might say, do you have fire extinguishers? Do you have this sort of equipment? We would take it to the next level of that sort of risk and actually ask for proof of servicing, proof of compliance with any dangerous goods legislation and things like that.
Okay, that's so good to hear. And I want to uncover that a little bit more. And you, in your opening blurb around, like the investment or car insurance difference, you spoke about this, but I want to dive into a bit more. So in your opinion, what separates like an insurer who goes, oh, complex risk, and as you said, oh, I'll lean into this, I'll get my mittens dirty on this one, or an insurer that goes, yep, no, I'm walking away? Are there any characteristics that you could speak to that separates those two philosophies?
There is, but I do want to debunk any myths about why an insurer may take on a complex risk versus not, because I don't want the perception to be out there that an insurer who takes them on is good versus one who doesn't, who's bad. There's different reasons why people might take on risks. So if you're a new insurer to the market and you're starting out, you might not have the growth or the premium behind you to support any large losses which come with it. So they might choose to not write that more complex risk for a very valid reason. Comparatively, you might have a well-established insurer who has been playing in the game for a long time, has more runs on the board with their capital provider and evidence of continued performance, and therefore they can take chances on more complex risks. So it shouldn't be perceived as someone says, well, if an insurer says no, they're bad, and the one who says yes is good. It's going back to the investor analogy. It's where they're prepared to invest their capital for what return. So I know, speaking on behalf of our group, the introduction of Flex Complex really complements our brand, because CHU itself has been around for nearly 50 years. We do all things Strata. Flex has also come in the last 10 years. Flex Complex really complements those brands by doing those more complex risks. So as an umbrella, as a company, we like to think we can provide as many solutions to Strata customers as possible, regardless of their situation.
I think that's become really clear to me over the last 20 minutes in hearing, and I loved the way you articulated, particularly in the tobacconist example, that it's not like oh no, I'm out. It's what measures are in place. What are the bollards there? It's not like, oh, tobacconist. Oh no. I really love how you've articulated that, because I think maybe that debunks the myth about, oh, this, no, this, no. There's actually deeper questions, and that leads to my next question for Frank. There are deeper questions and considerations that are made that we're able to assist as many people as we can. So Frank, back to you, and specifically with regard to Flex Complex. If your bat phone rings and you get a call, hey, Frank, we think we've got a risk here and we think it might fall into the complex arena. What are those critical pieces of information that you'll be requesting or asking for from the person on the other end of the phone, so you can give your team the green light to go, all right, let's go. Like, how do we make this a reality, and how do we get this happening for this client or customer?
Yeah, so we'll start with all the fundamentals of the policy, like when is the inception date? So when we went live with Flex Complex, we had a 3-month timeline to actually write new business risks. We've since compressed that to under a month. So I'll look at what the inception date is, what the total sum insured is for the building, what the location is. So I'll kind of do those pre-qualifiers up front. We'll then understand if the building is currently insured and have a look at that. And then once we know that and we're still in a position to provide terms, we'll start to dig into why this risk is considered a complex risk. So understanding if it's defects, if it's tenancy related, if it's about cladding. So really delving into what those are. Now the beauty of it is that while we've started where we are in terms of what we can write, we are trying to constantly update and innovate the product. So we'll send it through, we'll have a look in there, but we'll get all that key information. So what we find is, because we are underwriting it in a way to try and find a solution, we might ask for all the reports, all the information, all the background that maybe hasn't been required previously, to ensure that our underwriters can go through and provide a solution knowing they have all the background and all the information. So we do the pre-qualification, we then ask for all the information, and that puts us in a good position to review all that insight, the papers, the reports, and be able to come back with any final questions and deliver
So
on terms.
just on that,
I might just add to that, Steve, if I may.
Yeah.
To lift the hood on what actually happens in the underwriting department when that sort of thing happens, the way I teach anyone in underwriting is, if you've got crosses on a risk, and crosses can be high exposures or complexity or concerns, you need some ticks to outweigh it. And that sounds really simple, but the reason for that is, if the building has a large loss, and let's be honest, you can have a very benign, boring 50-unit residential building which could burn to the ground, and that's not considered complex at all. But the reason I bring up crosses versus ticks in the underwriting sense is, we need to be able to justify to our capital provider why we've made a decision, if there's a large loss. So if there are concerns about security of a nature of the occupancy, which might be deemed in loose terms as a cross, what ticks are there to make the risk palatable? What ticks are there to make it manageable? And that's the sort of information we're looking for. So we've got all these crosses, and I know it's got a negative connotation, but I'm just using it to outline the metaphor.
Yep, understood.
You've got all these crosses. To offset them, what ticks do I have? So if I get asked a question, why did I write this? I can say, well, because I did it because of X, Y, and Z. And that could be, well, yes, they have had a heap of claims, but they've taken proactive steps to do preventative work on their plumbing, to install adequate fire protection, to increase their security. All these factors are saying, well, yeah, there is a concern here, but the customer's done everything fair and reasonable to try and negate it. So we can consider this one. That's a risk we're more prepared to consider, rather than a risk which just has crosses and no ticks against it.
Yes, that's becoming more clear as you guys are speaking. There's no blanket no and blanket yet. It's like, how are we getting to that yes? And I love that. So I guess my question to Frank or to Steve or both of you is, in your experience in dealing with complex risks, and I'm giving you the opportunity to speak directly to all of the people on the call right now that might be going, oh, I think I do have a complex risk, and I would love to hear more about how can I place that in making those decisions. And Frank spoke about all of the pieces of documentation that are required to make an informed, correct, and accurate decision, in order to help those lot owners at the end of the day. Both Steve and Frank, is there a piece of information that is often missing, or that delays those decisions in getting you able to make that decision and get that across the line as quick as possible? Because, again, we want to make as least impact as we can to those lot owners. So is there something that people on the call can assist your teams with to get that information quicker and that decision back as quick as possible?
I believe so. I think if people are looking at complex risk and sending a standard submission, that's probably not the way to go. And when I say a standard submission, I mean a standard quote submission. It should be really with the view of providing as much information as possible to prevent the back and forward going on. Now, that might not be able to answer all questions. Present the risk how you would want it. Always put yourself in the insurer's shoes. Say, if I was an insurer, what would I want to know about the risk? In the introductory dialogue we were having, I was saying, if you strip the very basics and lift the mystique of insurance, most people probably understand the questions they need to ask. If you know that you've got a security risk, if you know there's a cash-heavy industry which is prone to theft and things like that, provide the information up front as to how they're trying to mitigate it if they are. I think that's the best way to look at it. So you don't need to be an expert, but think, what would I want to know if I was insuring this risk? And you've probably answered 95% of your questions. Yeah, that's how I'd handle it. But it's also worth noting that's why Flex Complex itself is a broker only product because of that level of complexity to make sure that the risk gets represented in the best possible light and that the interests of the insured are represented.
Understood.
Yeah, I like that. And I think what we're seeing is that the more a broker engages with Flex Complex, the better they are at actually knowing what information is to be provided. So I would encourage brokers who maybe haven't used Flex Complex yet to start sending through those quotes, because you'll soon pick up pretty soon the information or reports that we require to be able to underwrite this in a way that's going to provide a solution or an outcome for you. But certainly those brokers who have been using Flex Complex from launch or from earlier on are aware of what's required. We're not getting the back and forth and not asking for information. And that really compresses the time frame from that quoting stage to from that quoting stage to that binding stage. So really getting used to it, understanding what's required, and only really happens from actually engaging with it. And I just to really re-emphasize Steve's point, those ticks and crosses. So we're going through these reports looking for ticks, right? We're looking for progress. We're looking for ways that we can provide a solution that we can base our decision on. So the more that's there, the more that helps us actually underwrite that risk.
Yes, that's really clear for me. Thanks for that explanation. But now I'd like to ask a question on behalf of everyone on the call. And even further to than that, I want to ask a question on behalf of all of the lot owners. So, Frank, all of the data that you said that you look for and you uncover, and you gave that great example around everything that you did in that case study to try and get as much accurate data to help you in bringing this to life, will that one day lead to a lot owner experiencing a lower premium, even if it is in a complex risk?
Yeah, it's a great question, Steve. So the team who underwrites Flex Complex, they're all level one underwriters. They're all incredibly capable and
Okay.
they're all looking for a solution. They're all looking for a way to move a complex risk over across to be ultimately be a standard risk. So what you're not going to be seeing is information just being archived, policy just being renewed. We're looking to work with the broker and the committee to try and provide a solution to constantly see that building improve and move it along to be a standard risk and ultimately a better premium. What we don't want to do is lower a premium by excluding everything, by increasing excesses, by really degrading the cover. It's not the intent at all. We're trying to improve that lot owner premium that they have to pay, ultimately through the back of working together and providing clear path and direction forward to how to move their policy into more of a standard risk.
That's such a great layout for my next question, and it's for Steve. So I hope you're ready for this one. Exactly what Frank had just said. Cool. We've got all of the data. I wanted to ask, from your experience and expertise, who is typically involved in complex risk decisions?
Really wished I listened to Frank's response so I could answer. No, sorry, good gear. As Frank alluded to, only the most senior underwriters touch the complex risk.
Yep.
And there's a reason for that. One is the expertise. Two is we don't want to burden the customer with unnecessary questions, and which are going to delay the process. But in terms of even higher up than that, deciding on insurer appetite and what risks we're actually prepared to accept, that would be at like a senior management level when you're negotiating your products with your capital providers and so on, writing your PDSs, what your underwriting guidelines are. So Flex Complex, as Frank mentioned, is in its infancy. It's been around for about 5 or 6 months, but Frank has also made it very clear that we're going to continually evolve that product. And that evolution of a product happens from getting customer feedback in, whether it's based on the sort of risks we accept or the conditions we apply, talking to our capital provider and making those changes. So I can tell you, Flex Complex, although it's in its infancy, has already had about 3 or 4 significant underwriting guideline changes in terms of excesses we apply and so on. So we're very nimble and agile. It's not set and forget and let's explore that in 2 years' time.
So if you had an opportunity to speak, and as you do right now, to everyone who's listening live and later through our YouTube channel, what do you think are the sort of the elements that are commonly misunderstood about complex risks? Because I've heard some already. Like, I think they're great. I just wanted to get you to sort of call it out clearly. What are some of those things that are often misunderstood about complex risks that we could go, oh, I'd love to like clarify that now?
My first thing which comes to mind isn't necessarily about the risk itself, but just the perception that if there are limited options out there in the market, that the one insurer who might offer terms is trying to rip that customer off or something like that. We've seen that perception across our brand. It's not the case. It's normally the insurer is trying to work with the customer to get a solution in order to provide something.
That's what
So
I'm
it's
hearing.
not it. I think that's a big misconception. And anything an insurer does is subject to compliance regimes and regulatory checks and things like that. The reality is, if an insurer was playing that game and going out of their way and ripping someone off, if that went to an AFCA, a hearing or something like that, they'd be called out and named and shamed. So I don't think any insurer who's here for the long term wants to play that game or have their name dragged through the mud. And to be honest, it's just not on brand with what we're trying to achieve. We're here to provide solutions. So I do want to try to debunk that myth of if there's limited options and only one or two provide it, that those insurers are rubbing their hands together saying, oh, let's up the premium further than we need to. Insurance doesn't work like that. The media likes to portray it like that, but it's not the reality.
I was hoping you'd say that, because that is exactly what I had thought coming into this conversation. But like, it's so good for you to call that out, because that's sort of the one main takeaway that I'm hearing around the flexibility and working with clients, brokers, customers to try to find that solution. Is that something that you'd agree with, Frank, and sort of certainly as at the helm of Flex Complex?
Yeah, absolutely. Like any other APRA regulated business, we have to validate our price and rate. So if a customer was to complain, we would have to go back to the underwriting notes, our underwriting guidelines, our PDS, and validate and justify any rates or premiums that we charge. So everything we do is audited, is tracked, and as Steve mentioned, we are not here to make a short buck and then leave. We are here to be a consistent long-term player in a market which is in full relationship based.
Very thorough response. And the next question that I would like to ask is to Steve, and it's a two-parter. So to ask the real question is the evolution of complex risks over the next 5 to 10 years. Where are they? What do we see them? But to ask that, I think we need to go back. And how did we get to this term in the first place? How did we get to a place where complex risks is a phrase that is known throughout the insurance industry,
Good
specifically for
question.
Strata? Yeah.
So if anyone wants to really nerd out from an insurance perspective after this and Google how insurance actually started out of a need to resolve a complex issue. And that was the transport of marine and marine cargo, like hundreds of years ago, being hit by pirates and the threat of losing goods and things like that. So I can't remember, I always get the year wrong. It was the 1600s or 1700s where insurance started on that basis of trying to resolve a complex problem. And it's grown out from then. So so insurance was born out of a need for complexity. And then obviously all these different products evolved, and as risks and exposures, whether it's physical property or liabilities, all these different products have popped up. But complex risks are going to continually evolve. So some examples I can give is 15 years ago, tattoo parlors were rarely touched by any insurers. And that's because of things you would have seen on your television, but perceived links to criminal activity or underworld activity and things like
Yeah.
that. Now I'm the only person in Australia who doesn't have a tattoo, and tattoos are so commonplace, there's been more people willing to come into the market. Oh, I do lie, I actually have a tattoo of Frank on my back, but that's the only one I have.
That's fine.
Yeah, but the new emerging market is tobacconists, which we've all seen on the news about
Yeah.
their links to the black markets and things like that. So if you said 10 years ago tobacconists were going to be on a complex risk, I think people would have said, why? Like, on what basis?
Yes,
But
right.
that certainly has evolved and will continue to evolve. So what's the next tobacconist? I can't really answer that. Time will tell. One thing we do know, which is the science is certainly backing up, is that weather and environmental factors is going to impact the insurance world and the world more broadly. And people might say, well, why are you linking that to property insurance? Well, think about it. If there's higher sea levels and warming temperatures, what does that mean for coastal areas? What does that mean for areas prone to subsidence? So on sea walls and
Yeah.
sea cliffs and things like that. There's some known emerging risks, but what's the next occupancy based one? Time will tell.
Yeah, and I think it's pretty key for underwriting agencies and brokers to stay very close because the market is so dynamic, it's so fluid. The change in occupancies be considered as complex has evolved so quickly and it's continuing to do so. So we're hearing feedback about other certain types of businesses, asahi, shops, hairdressers, mechanics. Like it, we don't know whether that will come through, but there could be other tenancies that come in that are considered high hazard based off where money flows. So it's something to work very closely on because there could be further changes and updates on there in a building which may have been a standard risk can potentially move fairly quickly to being a complex risk or potentially uninsured. So that's why it's key because the tobacconists happen very quickly, first in Victoria, then interstate. So it's very key that we work very closely together as this market, which is so dynamic, keeps changing.
What about the thing that everyone's talking about now beyond complex risk, and that is AI and technology? Do you see any role that will be played in the complex risks landscape of technology or AI?
Good question. I think certainly it's not necessarily my answer's not necessarily geared towards complex risk, but any big data and AI in terms of making the quoting process more streamlined, easier to do business, should make things easier for the customer. Will that extend to complexity? Depends what a matter of public record is. So if you're insuring risks which require criminal history checks or things like that, depends how far AI advances. That sort of thing tends to be kept behind a veil of sorts and with good reason. So it's a watch this spacing, but certainly in terms of the way we do business, the way we transact business, and trying to ask as fewer questions to the customer as possible so they can just literally say, I'm Strata Plan 123, give me a quote. That would be the end dream. That would be the vision. We don't even ask them any more questions. How quickly we can get there or how easily we can get there, time will tell.
And yeah, it's so interesting, and I think it is really, especially within the like how quickly AI and tech is happening, what that looks like for this particular space. So I was just interested in your opinion. There is what I'm hearing. Is it fair? And correct me if I'm wrong. Is it fair to say that like in 5 years, anything, because we just don't know, anything could be considered a complex risk for a number of reasons. We just don't know. And anything could happen in the broader market, in the broader environment, in the broader atmosphere. Anything could happen. Is that fair to say?
Yeah, definitely. You track back through the history of building construction. So asbestos, when it came out, was used heavily. We all know the concerns and lawsuits and the exposure to health which asbestos can represent when it's not contained properly. What came out in the last few years was those specific Caesar stone bench tops and the impact that can have on people. So was that known to the average person 20 years ago? I dare say it wasn't. So what's the next one of those? Any of these things are arising and evolving. So to Frank's point, we need to stay as close to it as possible. But anyone who's got a crystal ball and thinks they can predict the next asbestos or similar.
What I'm hearing is that there's a need, especially from Flex Complex and the launch of this, is there needs to be that constant agility around understanding what's happening, not only in Strata but in the broader market. in the way we live, so that the team can, be agile and respond to what's going on. So I guess that's a penultimate question for Frank around the product of Flex Complex, and how will it change over time, if at all, and what influences will happen for that particular policy, and what that means to the market.
Yeah. So we see ourselves as an agile business. We see ourselves as a business that responds to the consumer need, and what the broker tells us they require to be able to serve their customers. So if we can look, when Flex went live last year October, we had one level one underwriter. We did a soft launch because we really wanted to just try out the process, the product, the customer experience. So it was very much a soft launch. What we've done over time, we've built it up. We now have 5 level one underwriters who write Flex Complex. Each month, we're writing more and more quotes. We're very happy to say that we open up Flex Complex to the entire market, and we're constantly evaluating and improving the whole Flex Complex proposition. So if we had have done it in launch and we found we didn't have things right, whether it be the wording or whether it be the rates or whether it be the underwriting experience, that could have been very detrimental to the brand. So there's a reason why we did that softer launch. And what we're doing now is constantly asking, both Steve and myself in particular, asking for that feedback, letting brokers know we're not offended. We really generally want your honesty. Now, we're incredibly blessed with Flex being in market for 7 years. We have very, very strong broker relationships, and that honesty is flowing back in terms of us to continually improve the proposition. Some of the key changes that we've made, we've greatly reduced the time to market. We started with 3 months. Now we can now do it within 1 month. We can potentially do the surveys post the binding period when the tenancy isn't a tobacconist. We can. One of the things we've also done is looked at the rates. So we saw on some various lines we weren't overly competitive. We'll then go chat to the London market to see how we can reduce those rates to make them more competitive and write business in that space. So we're really looking at constantly how we update it, improve it. We've reduced our standard excesses. We've had a lot of feedback. We're 6 months in, but I state very clearly here, I want Flex Complex to be the market leading Flex Complex hard to place proposition in the market. And that's the goal that Steve and I are working towards. And that only comes directly from that broker feedback. Now, the market is dynamic in lots of ways, and that includes the hard to place market. So we're constantly getting this feedback. We're building it up, what we do. When we have the renewal this year, we're constantly getting this feedback to see what additional underwriting authority or capacity we could do. Now, we know where the requests are. We know what people would like us to write, in what location, for what tenancies, under what size. So what we're doing is constantly feeding this back. When we go for the renewal, that's the right time for us to have those discussions. So please, any feedback that you have for Flex Complex, we really value it. And I don't want people thinking, I won't send this through because this is not in their guidelines or appetite. We seek all of that, because what we do is capture that information, and then we can speak back to London markets about the opportunity that's available across various lines of business that we don't currently write. So we really seek what we've got. We want to ensure that we move this product to be the lead in the hard to place space.
Just to reiterate, I'm not really sure I can sum anything up better than that. I think that's a great place to park this conversation. But Frank, what I'm hearing is that you'd be really open, or an open invitation to get feedback on the product, to ask any questions, inquiries of your team at any time.
Absolutely, we are, and that's what we seek, and that's what we'd want, and that's what we'd hope, right? And that's the honest truth. So we know what happened was when we got the feedback that the complex product was required, that there was additional capacity required in the market. It went from a concept at the beginning of last year to going live. Now, that's a pretty condensed time frame to launch a new product, totally new to the CHU group. So we understand that time was of the essence to launch this product, and with the market continually changing, that it may not have hit the mark in 100% of the areas.
Yeah.
So that's the feedback that we seek as we get it. So 6 months in, we've had a lot of feedback. So it really is continually getting that. So yes, we would hope that feedback continues to flow. The brokers will engage with Flex Complex and continue to give that feedback as we move along.
Understood. Steve Tchepak, last word. You have all of the people on the line right now. I'm not sure we can just top how Frank closed that out, so I'm going to give the microphone over to you. If there is one message as it relates to complex risks to those on the line now or watching later, what do you think the key takeaway from our conversation about complex risks should be?
Don't stress about whether a risk is complex or not. If you have a quote submission with Strata and you think we can help, send it through and we'll let you know what category of risk it falls into. I don't want you sitting there stressing in your offices thinking, where do I send this? Is it complex? Is it not? Send the quote request through and we'll do our best to help you.
Absolutely.
Sure.
And just to add to that, it's all Strata, resi, mixed use, industrial, commercial. Send it through. Please engage with us. We'd love to work with you.
Boom. You heard it here first. Guys, Steve, Frank, thank you so much for your time, knowledge, experience. Really appreciate you taking the time to be with us today and giving us insights into complex risk. I certainly have taken away a lot from the conversation. It's a lot more clear to me and less scary, the whole issue of complex risk. So thanks for debunking that and breaking that all down. I hope you had time joining us on the conversation, Frank.
I loved it. Thank you so much.
Steve?
Beautiful words.
Thank you so much, guys. And now over to you. The biggest thank you for you, as always. Thanks to all of those that have logged in live. And just a reminder, give our team some time to get back to you with those continuous professional development certification. They are coming. And now I want to close out the only way I know how. Join us next month for another exciting and engaging conversation for Strata in Conversation. I hope you've enjoyed this one. My name's Steve Brisson, and until next time, bye-bye.